Thank you, Kallanish, for inviting me to join your latest conference on the scrap market outlook. Certainly interesting times in the global ferrous markets, and none more so than the scrap market, of course, in recent months. So I'm here today to share the thoughts on where China is going and how it will affect the global scrap prices in both the near term and also looking further ahead for the rest of the decade in terms of the structural story for China's scrap generation as well. So for now, yeah, the scrap prices certainly do seem well supported in the near term, but we do see a lot of risks looking into the second half. So where are we today with the market? Well, clearly underlying demand in China, ex-China, is doing pretty well today. And of course, we have very easy comps for the first half of the year. Last year, China was in lockdown for all of February and March. Rest of the world, of course, locked down for most of 2Q. So all of the annual growth rates for demand for production are going to be printing very strongly in the coming months. So with that backdrop, of course, we do expect Chinese steel demand and production to be positive this year. That said, looking ahead to the second half, I expect to see some weakness emerging. Obviously, second half last year was extremely strong in China with both the stimulus aspects, construction activity, and the recovery in the consumer, both domestically and offshore, boosting all the exports. So that's why Chinese steel demand was so strong in the second half of last year. But this year, we're looking at an inverse to what we saw last year. So we do expect China gradually tightening monetary policy through the year, given especially the very elevated prices across the commodities energy space as well. And we do expect some weakness to see in the property market this year. China is in the first year now of the new 14th five-year plan. That's got a lot of structural shifts from the 13th five-year plan, one of them clearly being lower property investment levels, lower urbanization targets, and potentially bringing in property taxes in later this year or next year. So you put all that together, we do think property construction activity will be struggling in the second half of the year. Equally, infrastructure activity with the kind of stimulus from last year starting to fade, much less stimulus support this year. We think that will equally be fading in the second half. And also on the export side, Chinese demand second half last year very much supported by strong steel exports, not of steel itself, but of the steel containing goods with the global restocking cycle. And equally, that will probably be fading in the second half of the year as well. So yeah, headwinds ahead on demand in the second half, but for now, certainly underlying steel demand doing very well. Of course, one of the big issues we saw in the steel market last year was China's turnaround in the trade position, where China has historically been quite a big net steel exporter. Last year, we saw a lot of steel imports heading in. A variety of factors there, which we'll come on to later. And that certainly is expected to reverse this year. And then, of course, looking at the raw material side of things, iron ore prices extremely elevated today. The iron ore market, certainly a tight market, but not in an extreme shortage. I think these current prices extremely elevated, well above any justifiable cost levels. So do expect some weakness in iron ore prices to emerge through the year. That will also then be lowering the cost base for steel and have a knock-on effect, of course, of lowering scrap prices as well. So China's reappearance as a ferrous scrap importer has, of course, been the big story in the scrap market for the last 6 months or so. So this chart here shows very clearly how the global steel scrap prices really disconnected, since China's absence as a steel scrap importer of 2019, 2020, kind of fading through 2018. We did see this pricing spread emerge where the onshore scrap market in China, extremely tight, severe lack of structural supply onshore, very good demand from the steel mills, both just because of the underlying steel demand and also the environmental push. And that's kept domestic scrap prices very elevated. Meanwhile, of course, ex-China, the global traded scrap market has seen the usual kind of cyclical volatility, but certainly structurally was trading at a discount there for a couple of years. With China obviously changing the regulations since the start of this year to allow high quality steel scrap imports once again, that's brought the Chinese traders, the Chinese steel mills back to the global scrap market and had the effect, of course, of bidding up global steel scrap prices to arbitrage with the Chinese domestic scrap prices. So the volumes of scrap that are flowing into China remain small at the moment. They will certainly increase strongly through the year, but we've already seen the impact on the market prices, especially, of course, with the ex-China global steel recovery. That was helping as well. But just the fact that steel scrap can now flow into China means that the global scrap price is arbing towards that China domestic level. Of course, the other thing driving higher scrap prices is iron ore, right? Scrap is always, obviously, as an input to steel prices. It does price off the alternatives of iron ore and met coal combined. So versus the pig iron cost. And yes, with iron ore and both met coal being very elevated at the moment, again, that does provide room for scrap prices to be holding up at higher levels also. So when we look at the history of the scrap prices in China, they've actually been elevated for a number of years there because of that structural onshore tightness. Now, 2016-17, when China started the steel supply side reforms and closed a lot of the induction furnaces, it's those smaller, especially the induction furnaces, which were using a lot of localized scrap generation. So when they closed, the domestic scrap market was actually quite weak. However, since then, with the push for Chinese steel production to increase its environmental standards, we've seen a great preference for adding more scrap in the blast furnaces, as well as, of course, the rise of the EAFs in China. And that's meant scrap demand has been doing very well and scrap prices are much higher accordingly. So you can see there last few years, scrap has been holding at very elevated levels. Now, with that structural tightness of the onshore scrap market and the lack of import supply, that has meant actually the EAFs at a structural disadvantage to the blast furnaces within China. We do tend to see EAFs historically having around a 200 RMB a ton worse margin than the blast furnaces. Equally, this chart as well shows there the historical EAF margins have not been great for the steel mills in China. They've been kind of fluctuating around zero there. At the best, the good periods, they might be up as high as 500 RMB, but quite often they have been loss-making in recent years. Now, despite that poor performance for the EAF margins, the production rates have actually been very strong. The underlying steel demand has been there, and yeah, the EAFs are always very reactive to that. EAFs, of course, much easier to operate than blast furnaces in terms of speed of kind of reducing supply or increasing supply. And certainly we do see that happening in China. So again, right now, Chinese New Year holiday, construction markets closed. Most of the EAFs have shut down temporarily. But as always, 2Q into March, into April, as the construction activity lifts, the EAF production will come soaring back. And we expect the production rates to be at extremely high levels before very long. So just looking at the steel market in China, it does look like it's going to be very strong for the second quarter. Construction activity, there's this clear narrative in China that with all the virus restrictions, that certainly reduced the amount of travel in China around Chinese New Year, 70% fewer rail journeys. So that means a lot of those migrant workers at the construction sites, at the factories, did not go home for the holidays. Therefore, they are ready to restart work much earlier than would otherwise be the case. So we are already seeing signs of construction activities ramping up much earlier. That in turn has lifted the demand for rebar, and that's partly why steel prices, of course, are doing very well. So steel production is normally at its strongest in the second quarter. That is the seasonal demand trend in China, especially construction-driven rebar demand. So again, expecting exactly the same story over the next few months. Rebar demand will be up and up, and that again will support the EAF production. That will in turn support higher scrap prices sustaining through the second quarter. The other angle to watch for, of course, on the steel inventory, with that activity coming back sooner this year, we do expect the inventory to start drawing perhaps a week or two earlier than normally. Normally, we have to wait 4 or 5 weeks after Chinese New Year for activity to really come back. This time around, it's happening already. So do look for those steel inventories to turn lower a little bit earlier. That in turn again will be very supportive for steel prices in the near term. So one of the big issues at the moment, of course, is China's steel trade position. So last year we saw China importing a lot of steel and exporting much less. So 2019, China was a net steel exporter of 50 million tons. Last year that fell to only 15 million tons. Now, of course, ex-China steel demand was very weak last year, so that partly explains that effect. But one of the other big issues was the scrap import ban in China. So with the Chinese unable to import steel scrap last year, the offshore scrap price was up to a $200 a ton discount to the Chinese onshore price. That in turn meant EAFs in the region, Vietnam, elsewhere, of course, highly competitive in terms of their steel production. So we saw China importing 20 million tons of semis last year because of that cheaper scrap raw material feed for the EAFs outside China, who were then able to undercut the Chinese domestic steel prices and send the steel in. So that's kind of a double negative for China here. Importing the steel scrap, it means that, yes, their scrap availability will increase, but actually it's crushed the competitiveness of the ex-China EAFs. It's leveled the global cost curve for EAF steelmaking. And that means that actually China will be importing a lot less steel. So their scrap imports may rise to 8 or 10 million tons this year, but we do believe their steel imports will be down significantly more, partly on the global scrap prices being much higher, and then also, of course, on the ex-China steel demand recovery, keeping more steel domestically in those regional producers. And at the same time, global steel prices, of course, especially Europe, US, at very elevated levels. So Chinese steel exports seem back in favor. We already saw in December export volumes recovering, and that certainly remained the case over the last couple of months. So for this year, for Chinese steel production, absolutely we're expecting a positive number, because the underlying demand is clearly going to be positive in the first half, even if it turns negative in the second half. We're going to have such strong growth with the base effect for the first half that Chinese steel demand will be a positive number for the year. And on top of that, if China is importing less steel and exporting more, the Chinese steel production will clearly be positive. So that then causes a big question mark over China's supposed announcements recently about trying to restrain steel production this year. We do think that will be a struggle, because the market is there, the demand is there. So China could well restrain steel exports, but the steel production domestically will have to be higher this year just to meet that. So another important driver, as we said earlier, for scrap prices is, of course, what's happening in iron ore. The iron ore price is extremely elevated levels, up at highest levels not seen since 2011, 12, 13 period. And that just seems far too elevated in our view. Yes, demand supply for iron ore, it's a tight market, but it's not an extreme shortage, right? Port inventory has been rebuilt to quite comfortable levels, and iron ore supply globally recovered very strongly in the second half of the last year. Supply is annualizing down about 250 million tons year on year between February and April last year. But by 4Q, we were back up to extremely high levels. Iron ore supply on the seaborne market last year actually at a record high by the end of the year, because of the high prices incentivizing a lot of production from those non-traditional sources. Places like India, a lot of junior mines in Brazil, Australia came back into the market with prices above $100 a ton. So yeah, iron ore prices today, $170 does feel extremely elevated. Now, last time we were here, 2011, 12, 13, the reasoning for those high iron ore prices was because we were incentivizing these very low grade, small private mines in China. They had a cost above $150 a ton for that marginal 100 odd million tons. Of course, China's cleaned up the mining industry significantly in recent years, starting anti-corruption, getting rid of illegal mines, more recently the environmental reforms. So a lot of that low-grade mining has disappeared, and it's not possible for that to come back in China. So the Chinese domestic iron ore supply is much less elastic than it used to be. It's kind of more fixed supply now. It's not very responsive to these high prices. So domestic iron ore last year rose about 10 million tons on our numbers, 268 million tons. This year, it's only going to grow another 8 million tons, because there just isn't the available capacity there to bring on in response to these high prices. Equally, all of that domestic Chinese production is profitable at $100 a ton. It does not support prices at that kind of 150, 170 peak levels that we're at the moment. This is very much a different market to what we saw 2011, 12, 13. And that's why I do think we should start to see weakness in iron ore prices before long. So that's the near-term story. If we just step back for a little bit and look a little bit longer term into the future, the Chinese ferrous scrap industry, of course, we've been saying this for many years, it is set for an extremely strong growth phase now in the 2020s, essentially reflecting China's steel consumption growth in the 2000s. Scrap is essentially a follow-through effect of steel consumption from many years ago. So China's steel consumption boom in the 2000s, when people started buying more appliances, more cars, a lot of the buildings going up, then you're now starting to see that scrap coming back. It was just as the cycle emerges. So scrap supply in China will be growing very strongly over the next decade. We think up to 350 million tons a year of scrap generation by 2030, from just over 200 million tons last year. So that's huge growth in the scrap supply. And of course, yes, the scrap demand will be there. That scrap will be consumed. Scrap will just price its way into the market, essentially undercutting iron ore. So the scrap demand, will come from the blast furnaces as well as the EAFs. China's got a huge build out on EAFs. Obviously, all the environmental push is just going to continue to see that switch from blast furnaces to EAFs emerging. But essentially, scrap will find a home somewhere in China. But as that supply emerges, of course, what we've seen in recent years, with EAFs being at a structural disadvantage to blast furnaces, having structurally weaker margins, at some point later this decade, we're likely to start to see the EAFs having better margins than the blast furnaces. As the scrap supply domestically grows more rapidly, the market becomes less tight. Eventually, scrap prices will probably start trading at a discount to pig iron, and therefore the EAFs will make much better margins later in the decade than they do currently. One other question we get asked longer term: is China going to become a scrap exporter? We certainly don't believe so. Obviously, China is very concerned about their security of supply of iron units. So we constantly see these policies, especially this year, China having a 45% security of supply on ferrous units. A lot of that, of course, will come from scrap, but equally, China is a massive iron ore importer. Having that domestic scrap availability will lessen that reliance on iron ore imports. So we do not believe China will allow steel scrap to be exported, certainly not this decade, not while they're still importing significant volumes of iron ore. Perhaps further out in the future, when China's a fully developed economy, and like the US, Europe, Japan has an abundance of scrap generation, maybe then we start to see China as a scrap exporter. But in the next 10 years, we don't believe that is on the cards. So that's it from me on the presentation side of things. We'll open it up to questions now. Thank you.